Interest is a claim on time you have not lived yet, and you agreed to it before you understood what time was worth. Every loan you have ever taken, every mortgage, every credit card balance, every student loan, underneath the numbers, beneath the percentage rate and the monthly payment schedule, there is something being exchanged that is almost never named. You are not borrowing money. You are selling your future hours. The interest is the price, and the price was set by someone who has never met you, in a room you will never enter, according to logic that has nothing to do with what your time is actually worth. Most people experience interest as a cost of borrowing, a fee, a necessary inconvenience of accessing money they need now but do not have. That understanding is not wrong. It is just not deep enough to show you what is actually happening. Interest is the price of time, and whoever controls the price of time controls what the future looks like before it arrives. Go back to the beginning, before interest rates, before central banks, before financial instruments of any kind, before even money in its modern form. Go back to the first moment one human being gave something to another with the expectation of receiving more in return. That moment is older than any civilization we have recorded. Cuneiform tablets from ancient Mesopotamia, some of the oldest written documents in existence, record interest-bearing loans from 5,000 years ago. Grain lent out at harvest to be repaid with interest at the next harvest. Silver lent with explicit percentage charges attached. The concept of lending more than is returned, of time having a price, is as old as writing itself. Why? Why did interest emerge so early, so universally across cultures that had no contact with each other? Because time is genuinely scarce. Because having something now is worth more than having it later. Because the person who lends gives up the use of their resource for the duration of the loan, gives up whatever they could have done with it in that time, and expects to be compensated for that sacrifice. And because lending involves risk, the borrower might not repay. The compensation for that risk is also embedded in the interest rate. These are real justifications. They make interest, in its basic form, a reasonable arrangement between people with different needs at different moments in time. That is what it is at its origin. But interest does not stay at its origin. It compounds, and compounding is where the ordinary becomes extraordinary in ways that restructure entire civilization. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he said it or not, the observation is accurate. Compound interest is the growth of growth. Interest accumulates not just on the original principle, but on the accumulated interest itself. The curve is not linear, it is exponential, and exponential curves look slow at first, and then, suddenly, they do not look slow at all. A loan of 100 at 10% interest, compounded annually, becomes 110 after a year. After 10 years, it is 259. After 30 years, it is 1,745. The original 100 has grown by more than 17 times without the borrower doing any additional borrowing and without the lender doing any additional lending. Time did the work. The compounding did the work. The numbers simply followed their own logic. Now ask what this means at the scale of an economy. What it means when millions of people carry compound interest-bearing debt simultaneously. What it means when the entire monetary system is, as we saw when we examined banks, built on loans that carry interest, which means built on a requirement that borrowers repay more than was created when the loan was made. Here is the mechanism that most people walk past without seeing it. When a bank creates $100 by making a loan, it creates the principal. It does not create the interest. The interest must be earned from somewhere else in the economy. which means the economy as a whole must grow continuously just to service the interest on the existing stock of debt. Not to become richer, not to improve, simply to stay current. Growth is not just desirable in a debt-based monetary system, it is structurally required. The interest demands it. And the interest never stops demanding it. This is one of the deepest roots of the growth imperative we examined earlier in this series. The compulsion to grow is not simply human ambition or corporate greed, though those are present. It is baked into the architecture of how money is created. A system that creates money as interest-bearing debt is a system that requires perpetual expansion just to remain solvent. The hamster wheel is not a metaphor. It is the engineering. Now go to where interest becomes political. Because the setting of interest rates, the determination of what the price of time will be across an entire economy, is one of the most consequential acts of governance in the modern world. And it is performed not by elected governments but by central banks, whose leadership is appointed, whose deliberations are partially opaque, and whose primary mandate is not human flourishing, but price stability. When a central bank raises interest rates, borrowing becomes more expensive across the entire economy simultaneously. Mortgages cost more. Business loans cost more. The credit that small businesses need to make payroll becomes more expensive. The credit that individuals need to bridge gaps in cash flow becomes more expensive. Economic activity slows. Unemployment rises. The intention is to cool inflation by reducing spending. The instrument works by making people's financial lives harder until they spend less. This is called monetary policy. It sounds technical. But underneath the technical language, what is happening is this. A small group of appointed officials is deciding, in the service of price stability, how much financial pain the population will bear and for how long. And the pain, as we have seen throughout this series, is not distributed equally. The person with a fixed rate mortgage feels nothing when rates rise. The person with a variable rate mortgage feels it immediately and feels it monthly. The corporation with a long-term bond issuance locked in at low rates is protected. The small business that needs a revolving credit line to manage cash flow is exposed. The wealthy person whose assets appreciate with inflation is partially hedged against the rising rates used to fight it. The renter whose landlord now passes on higher costs is not hedged at all. The interest rate is a blunt instrument striking an economy that is not uniformly shaped. The bruises land where the skin is thinnest. Now go to the global dimension. Because interest rates set by the United States Federal Reserve do not stay inside the United States. They travel. When the Fed raises rates, capital flows toward dollar-denominated assets to capture the higher return. Capital flows out of developing economies. Their currencies weaken against the dollar. The goods they import, priced in dollars, become more expensive. Inflation rises in countries that had no role in the monetary decisions causing it. The debt they carry, often denominated in dollars, becomes more expensive to service as their own currencies fall. Countries that were managing their debt loads adequately find themselves in crisis, not because of anything they did, but because an appointed committee in Washington adjusted a number. This happened in 2022 with particular severity. The Fed raised rates faster than at any point in decades. The dollar strengthened significantly. Capital fled emerging markets. Sri Lanka had a debt crisis. Pakistan had a debt crisis. Multiple African countries faced acute fiscal stress. None of them set the rates. All of them felt the consequences. The price of time set in one room reshapes the futures of people in countries thousands of miles away who had no seat at the table and no vote on the decision. Interest is not a local phenomenon. It is a global transmission mechanism through which the monetary decisions of the powerful travel instantaneously to the balance sheets of the powerless. Now go to something even less examined, the moral history of interest. Because for most of recorded human history, charging interest on loans was not considered a normal commercial practice. It was considered a sin. Aristotle argued that money is barren. It does not naturally reproduce. To charge for its use across time is to charge for something that does not exist, future money that has not yet been produced. It is, in his view, the most unnatural of all forms of wealth-making. Medieval Christian doctrine forbade usury, the charging of interest, on the grounds that it was selling time, and time belongs to God. Jewish law prohibited charging interest to fellow Jews. Islamic finance prohibits riba, interest, to this day, on the grounds that money should not make money simply through the passage of time, that profit must be connected to genuine productive activity and genuine risk-sharing. These prohibitions were not primarily about protecting borrowers from exploitation, though that was part of it. They were about something deeper, a recognition that the compounding of money across time, disconnected from productive activity, violated something in the relationship between human effort and human reward. That money growing simply by existing, while the borrower labored to repay it, was a form of extraction that the moral imagination of multiple independent civilizations found troubling. The financial revolution of the 16th and 17th centuries dismantled these prohibitions systematically. The growth of commerce required credit. Credit required interest. The moral frameworks were reinterpreted, argued around, and eventually abandoned in most of the cultures that adopted capitalism. Interest became normalized, then celebrated, then invisible. The question of whether charging for time is morally defensible became a question nobody asked anymore. But the Islamic finance tradition continued asking it, and the alternative structures it developed: profit-sharing arrangements, equity-based financing, risk-sharing between lender and borrower, rather than risk transfer from lender to borrower, are not nostalgic relics. They are responses to a real problem. The problem that a system built on interest is a system built on a relationship of extraction between those who lend and those who must borrow. And the people who must borrow are, by definition, not the people who own enough to lend. Here is the thing that stays with you when you see this clearly. Every time you pay interest on your mortgage, your car loan, your credit card, your student debt, you are participating in a system whose architecture requires you to pay back more than you received. Not as punishment, as design. The extra payment is not a fee for a service. It is the price of having needed money you did not have. It is the cost of not already being wealthy. And that cost compounds. Across the life of the loan, across the lifetime of the borrower, across the generations of families whose wealth never quite accumulates because the interest payments extract from it continuously. The wealthy person who lends does not pay interest. They receive it. Their money grows while they sleep. The person who borrows pays it. Their money shrinks while they work. The system is not broken. This is the system working exactly as it was built to work. The question that stays open after all of this is not about interest rates or monetary policy or central banking. It is more personal than that. Every hour you worked this week, what portion of it went to paying for the past? To servicing the cost of needs you had before you had the money to meet them? And what would your life look like if that portion did not exist? Not because debt is avoidable for most people. It is not. But because the hours of your life that belong to interest before they belong to you are hours you have never counted. And uncounted things have a way of running out before you notice they were going.